Welcome back to Talk Tickers, the show for the professional investor, where we strip away the fluff, ignore the PR spin, and get straight to the cold, hard numbers.
We take the earnings calls you don't have time to read and find the signal in the noise.
Today, we are turning our sights on a regional banking powerhouse that is trying very, very hard not to be boring. We're talking Third Bancorp, ticker symbol FITB.
And if you were watching the tape on Tuesday, January 20th, the market had a bit of a mood swing on this one.
It really did. It felt like a classic sell the news event, or maybe even, a good news is priced in kind of day.
I think that's the perfect way to frame it.
So let's do the vibe check. The stock popped right out of the gate. I mean, it hit a high of $50.50 intraday. That's a nice 2.7% jump.
Everyone's cheering.
Exactly. But then it just sort of faded into the close, settled around $49.41. It feels like the market's saying, great quarter, we knew it would be, now show us the hard part.
And that's the setup. The numbers themselves were solid, no question. But the real story here isn't the quarter that just passed. It's the massive strategic pivot happening with the Comerica acquisition.
Right. The big question is whether the execution risk is worth the premium.
Exactly. It's indigestion, as you said. But before we get to the merger and some of the wild strategy stuff and folks, we have to talk about robots and snail mail.
Oh, we do?
We have to respect the scoreboard first. Let's unpack the action at the fraction. Give us the headline results.
Okay, headline numbers, Fifth Third delivered. GAAP EPS came in at $1.04, but the number the street really cares about, adjusted EPS, hit $1.08.
And that was against a consensus of $1 flat.
So an 8-cent beat, let's pause there for a second, an 8-cent beat in this environment, that feels pretty significant.
It is absolutely significant. I mean, analysts usually have these models dialed into the penny. To miss by 8 cents to the upside suggests the bank is running hotter than people thought.
It's not a rounding error.
It's a statement. And the top line, revenue at $2.35 billion. That's up over 63% year over year.
Wow.
Now, there's some noise in there, but the core engine net interest income, or NII, that came in at $1.529 billion. Net interest margin of 3.13%.
Okay, let's break that down for listeners. NIM, 3.13%. Good, bad, ugly. Where does that sit?
It's solid. It's very solid. Think of it as the bank's gross profit. It's the spread between what they pay you for deposits and what they charge for loans. 3.13% shows they're managing that spread really effectively.
Okay, but you said that wasn't the number that really caught your eye.
No, it wasn't. For me, it was the profitability, specifically the adjusted return on tangible common equity, ROTCE.
The acronym that sounds like a sneeze.
It's the most important one in banking. It's the bang for your buck metric. How well do you use shareholder capital? Fifth Third hit 20.5%.
Whoa, okay, let's frame that. Usually when we cover a regional bank, if they hit 15%, they're throwing a party.
15% is respectable, 17% is great. Breaking 20% ROTCE is, well, it's the gold standard. It puts them in the absolute top tier of U.S. banks.
And they did this while keeping costs down.
Exactly. Efficiency ratio is 54.3%, which, simply put, means for every dollar they bring in, they only spend about 54 cents on everything else.
That is a lean machine.
It really is. And this is why this story is different. This isn't a turnaround play. This is a strength-to-strength story. The balance sheet is a fortress. Loans up 5%. Deposits up 7%. The fundamentals are pristine.
So if the car is running so perfectly, why did the stock fade? What's the nervousness about?
Because the driver just decided to swap the engine while doing 60 miles an hour. We have to talk about the Comerica deal.
The $10.9 billion all-stock acquisition, it's a massive bite to chew.
It is. And it is moving at warp speed. They got all regulatory and shareholder approvals in less than 70 days.
That's unheard of. Usually regulators drag their feet for 6 months, a year sometimes.
I know. Legal day one is February 1st, 2026. That's next week. But the real flex, the real show of confidence, is a systems conversion.
That's the big one, the moment where everything can break and customers get really angry.
Right. It was originally scheduled for mid-October. They've moved it up. They're now targeting Labor Day 2026.
Pulling it 4 by 6 months, that's confident.
Incredibly confident. And what that does is it pulls their profitability targets forward. They're now saying they expect to hit their 2027 return targets, that 19% ROTCE range, in the fourth quarter of 2026.
That is just aggressive. You're putting a target on your own back with a statement like that.
You are. They're targeting $850 million in synergies, and they hinted they could hit $400 million of that in 2026 alone.
Okay, devil's advocate here. Why are they so confident? We've seen so many bank mergers turn into absolute nightmares. Why does Fifth Third think they can sprint through this?
This brings us to my favorite nugget from the entire call. It's what I'm calling the First Republic effect.
First Republic, the bank that failed a couple of years back.
Correct. So CEO Tim Spence mentioned something fascinating. He said that losing the bid for First Republic actually made them 2x the bank internally.
How does losing make you better? Explain that.
Well, think about what it takes to even bid on a failed bank like First Republic. You have to prove to the FDIC that you can absorb a massive institution literally overnight.
Okay.
So Fifth Third spent months upgrading all their systems, their back office, their capacity. They stress tested their ability to basically double in size instantly.
So they did all the prep work.
And then JP Morgan won. But Fifth Third was left with this upgraded high-capacity machine. That failure was basically the training camp for this Comerica integration.
That's a great perspective. It's like training for a marathon you don't run, so when a half marathon comes up a month later, you just crush it.
Precisely. They are using the muscle memory from the First Republic bid, and that confidence is bleeding into their strategy.
Which brings us to my favorite part of this, the Tim Digital versus the mailman duality.
It is such a study in contrasts. On one hand, you have Fifth Third executing what looks like a 1990s growth playbook.
I mean, they are dropping 13 million pieces of direct mail, physical envelopes, paper, stamps.
In Texas and the West.
Yeah.
And you have to ask yourself why. In 2026, why on earth is a major bank doing this?
Well, analyst Mike Mayo asked the CEO that directly. He called him out on his nickname, Tim Digital Spence, and basically said, why are you using billboards and envelopes?
And the answer is a brilliant regulatory loophole. They own Comerica, but until that system conversion in September, they cannot legally digitally acquire Comerica customers. The digital door is locked.
You can't run Facebook ads targeting them.
Not easily, no. But the physical mailbox, that's wide open. There's no law against sending a letter. It's analog arbitrage.
It's hilarious. But it's not just mail, right?
No, it's bricks, too.
Yeah.
They're opening 150 brand new branches in Texas. And get this, 40 of those locations are already secured.
How do you move that fast on real estate?
Old school relationships. They spent years expanding in Florida and the Carolinas. They use certain real estate developers. Well, those same developers build strip malls in Dallas and Houston.
So the developer just calls them up and says, hey, I've got a corner spot for you in Houston, just like the one you have in Orlando.
Pretty much. And speaking of Florida, their 200th branch just opened there. If Fifth Third Florida were its own bank, it'd be the 44th largest in the entire country.
That is some serious scale. Okay, so that's the old school. Now let's flip the coin to the new school. This is where Tim Digital earns the name.
This is where it gets a little sci-fi. Their embedded payments platform, Newline, doubled revenue year over year, pulled in $1.4 billion in deposits. That's the tech engine.
But then they launched something called a Model Context Protocol server.
Okay.
Unpack that for us in plain English. What is that?
All right, so think about it this way. Right now, a human uses an app or a chatbot to talk to a bank. This new protocol is a server designed to let AI agents talk securely to the bank's API.
So not a human typing, a robot talking directly to the bank.
Exactly. Imagine a huge corporation with an autonomous AI agent managing its cash flow 24/7. Fifth Third is the first U.S. bank to build the infrastructure to let that AI plug directly in.
So on one hand, they are paying for stamps to mail letters to grandma in San Antonio. On the other, they're building servers for AI bots to run corporate treasuries.
It's a barbell strategy. And it's brilliant. Use the analog methods where there's no competition to get sticky retail deposits, and use the bleeding edge tech for high-volume commercial clients.
It covers the whole spectrum. Okay, let's pivot to the loan book. I loved the phrase management used for the economy right now, chronic postponement syndrome.
Yes, this was their explanation for why commercial line utilization dropped.
So companies have credit lines available, but they aren't using them.
Correct. The credit is there. The businesses just aren't drawing down the cash. Management says clients are suffering from chronic postponement syndrome. They're putting off big investments, new factories, equipment because of all the uncertainty.
The wait-and-see economy?
Exactly. Waiting on tax reform, geopolitical stability. And at the same time, we saw corporates paying down debt to clean up their balance sheets for potential M&A.
Right, the corporate cleanup.
But here's the key counterpoint. Even with lower utilization, commercial production, so new deals being signed, that was up 20% sequentially.
So the sales team's getting the contracts signed. The clients just aren't tapping the keg yet.
The plumbing is installed, And credit quality is just defying all the doomsday narratives. Net charge-offs at 40 basis points, that's the lowest in 7 quarters.
That really flies in the face of the whole creaking commercial real estate story we keep hearing.
It does, and it creates this fascinating setup. If you connect chronic postponement with those production numbers, you get what I call the coiled spring theory.
Okay, explain that.
Well, the demand is there, that's the production, the capacity is there, that's the credit line. The only thing missing is confidence, if that uncertainty breaks.
NII could explode to the upside in late 2026.
Precisely. You are betting on the dam breaking.
So what are they telling us in the guidance for 2026?
They're calling it a remixing year.
A remixing year, like an EJ.
More like a portfolio manager. They're optimizing the combined balance sheet of the two banks. They're guiding NII to between $5.85 and $6.15 billion.
Okay, and what about that net interest margin?
They see a jump. They're guiding NIM to between 3.15% and 3.25%. That's about a 15 basis point jump after the merger closes.
And for the shareholders, what's the story on buybacks? I assume they have to wait.
You have to wait. Share buybacks are paused until the second half of 2026.
Which makes sense. You don't buy back stock when you need capital to close a massive deal.
It's just prudent capital management. The dividend is the priority. The goal is to get everything clean and ready for a best-in-class 2027.
Okay, so let's pull back. Why does this matter to someone who maybe just owns a bank ETF?
Because Fifth Third is proving that the playbook for regional banks isn't dead, it just requires scale. They are executing the Southeast plus Texas strategy. That is the highest growth corridor in the entire U.S.
It's a demographic play as much as a banking play.
It is. And the stock's reaction, that pop and fade, it tells you the market is still cautious. They want to see the integration work. If they can pull this off by Labor Day,
They become a top-tier super regional.
and those trade at a premium.
Okay, that brings us to my favorite part of the show, the This Is Not Financial Advice segment.
Disclaimer time. We are not financial advisors. Do not do what we say. This is for entertainment purposes only.
We're just two voices in your headphones. But if I were pitching a wild asymmetric trade to my investment committee, here's what I'd pitch. I call it the snail mail alpha long short.
Snail mail alpha. I love it already. Lay it on me.
Okay, the long side. You buy Fifth Third. Why? Because they have a monopoly on analog arbitrage. They're the only ones sending 13 million letters to Texas grandmothers while also running AI servers for tech bros in Austin. It's a hedge against the digital ad bubble.
That is surprisingly logical. It's a physical distribution moat. And the short.
You short a basket of pure-play digital neobanks.
The fintech darlings.
Exactly. Their customer acquisition costs are sky high in a digital bidding war. They are fighting for pixels. Meanwhile, Fifth Third is physically intercepting customers at a grocery store strip mall in Houston.
That's a fascinating take. You're betting that in a noisy world, a physical letter is actually the stronger signal.
And here's the kicker, the option play. You buy out-of-the-money calls on FITB for Q4 2026, specifically targeting the cure for chronic postponement syndrome.
Betting on the dam breaking.
You're betting on that one Tuesday when tax clarity hits and every CFO in America draws down the revolver on the same day. NII spikes, stock rips.
That is outrageous, but I have to admit it's completely plausible based on the call.
We find the narrative, the algorithm misses.
To recap reality, though, Fifth Third delivered a strong beat. The massive Comerica merger is accelerating. Chronic postponement is holding back loans for now, but the future looks incredibly efficient.
And if Tim Spence can pull off this Labor Day conversion without breaking the bank, he absolutely earns that digital nickname, even if he did it with paper envelopes.
It is going to be a fascinating year to watch.
That was the Talk Tickers breakdown of Fifth Third. Remember to do your own due diligence. We'll see you on the next print.